This chapter, we will talk about revenue recognition and some of the different unique scenarios that are involved. So basically, revenues are when a company's making money, so they could either be selling goods to consumers or they could be providing services or rental activities, things like that. But it's basically what they're doing for their general operations of a business. So how do they make money? So obviously that's a big part of their financial statements is that revenue. So we want to make sure that it's always recorded accurately and in the correct period. So we've got 5 steps. So identify the contract, identify the performance obligation, determine the transaction price, allocate the transaction price if necessary, and then recognize the revenue when it is earned. So here it gives you again a little bit more details. So the contract is establishing who the seller and the customer is. We can have a single performance obligation where we're sending them a part one time or a product one time or we're performing a service, or it could be multiple. So maybe say it's a service contract and they're paying us for a quarter and we're going to then, every month perform specific services for them. That would be an example of a multiple one. We need to know the transaction price. So again, what is the seller entitled to receive? Some instances, there's going to be no allocation. Again, they're just buying a single product. If it's multiple, so maybe say, again, either like with my example, like a service contract that's over a quarter and you're performing services each month, or it could be like you're buying a product along with a service agreement. So like you're getting 2 things in that purchase. So those are another type of an example that we might need to allocate how much goes to the product and how much goes like to the service contract. And then we want to recognize it when we've earned it. So again, it could be over like a period. So say it's a single month of services. At the end of that month, we're going to record it. If again, we're just selling one product item to them, that's going to be at that point in time. And then the multiple again is when we've actually performed it or earned it. Okay, so then we've got kind of going through the details of that. So at a single point in time, again, is obviously it's the easiest. So let's just use that example of we send them a product and they've got to pay us. So they've got an obligation to pay us. Legal title has passed to them. They've got physical possession of it, the risk and rewards of management of ownership, and they've accepted it. So they've got the product, they owe us. We'll do this TrueTech through all the examples. So this TrueTech sells a gaming console and allows users to play the games individually or online. So if there's no other, all we're doing is shipping them the gaming module, no other goods or services, as soon as they ship those 1,000 boxes at $240 each, they're going to record the revenue. So then here is the entry. So we're going to, because again, they've got till the end of January to pay, but we debit accounts receivable, we send them a bill, and we record the sales revenue. Then when they pay us again at the end of January, it's due. So then the cash comes in and we reduce that accounts receivable. So then again, that's just the easiest type of one. Now then, let's say, again, it's over a period of time. So, they're giving us an example of a cleaning service. So maybe you come in once a week and then you bill them at the end of the month. In this example, that's the first example. So then if the customer controls the asset as it's being created, so we'll talk about construction contracts. Again, those will be, as work is being done, there'll be bills made like in process or in progress. And then if the seller is creating an asset with no alternative use, so the seller has a right to receive those payments in progress. So again, it's kind of like instead of constructing a building, but constructing a bigger asset. that, again, nobody else is going to take. It's like a contract job for the government. They too can get paid as it goes along, as they've performed services and it's a certain percentage complete. Okay, so then we're back to the TrueTech. So they're doing the gaming consoles. They sell 1-year subscriptions and they sell 1,000 of those. So when they sell them, the people have to pay up front. So cash comes in, but they haven't earned it yet. So TrueTech hasn't done anything yet. So it goes into deferred revenue. And then remember, deferred revenue is a liability to the company. Then as time goes on, they've earned it. So after the end of the first month, we're going to take it out of deferred revenue and put it into service revenue because a month has passed and we have earned it. And then notice as we look down below, we'll do that every month. That would be part of our adjusting entries. Okay, so if the, if the performance obligation doesn't meet any of the 3 criteria, we would recognize the revenue at the point in time when it's completely satisfied. And then again, that's usually at the end of the contract. So we're not going to do it in advance if it doesn't meet those criteria. So again, like in those types of like building contracts, or like I gave you the example of the government contract where we're building all these airlines, we always have to look at it to say, okay, what progress have we made towards completion? Because that's going to be what we're allowed to bill them for. So if it's output based, it's going to be a proportion of the goods or services that have been transferred to date. If it's input based, it's going to be a proportion of the effort expended relative to the total effort expected. So again, that's still kind of a percentage. It's just looking at it in a different way. So we've got to, again, identify the contract, identify the obligation, determine the price, and then allocate that transfer price to the performance allocation. So again, same steps we had. So step 2, again, identify the performance obligation. So we've got the seller promises to provide a good or a service in exchange for being paid. So the good or service, if it's capable of being distinct and separately identifiable, then we're going to recognize that. If there's multiple performances all in that same price, then we're going to have to allocate it out according to the value associated. So then they give us the example of, again, the same place, the same TriBox or TrueTech. So they've got the gaming system that plus a 1-year subscription. And then they're going to sell it as a package deal for $250. So again, the customer's getting the gaming module plus the 1-year subscription, and they're saving what, like $50 by doing it as a package deal. So if they deliver 1,000 of those at that package deal price, they're going to get the $250,000. So in this case, they are capable of separately identifying them. So they're getting the actual gaming system as well as the subscription. So we have 2 separate things. So we can identify that, yes, there is a contract. Yes, we have 2 different things. We know that the price is $250,000 total. So then now how do we allocate? So we go back and say, okay, the standalone module was $250. The standalone subscription is $60. So that's a total of $300, and they're getting it for $250. So then we're going to allocate it out based on that percent. So if we take the 240 divided by the 300 total value, 80% of the value should go to the gaming system. The remaining 20% should go to the subscription. Then we apply those percentages to what they actually paid. So then the gaming system is going to be worth 200 and the subscription worth 50. So then here's the journal entry when we get the money, or when we bill the customer. I guess we haven't gotten the money yet. Debit the accounts receivable when we bill them. record the sales revenue for the gaming systems, and then the subscriptions, again, because they're a year in advance, would go to deferred revenue. So we'd have the 50,000. And then we'd go through the same thing, that as each month passes, we're going to take that 50,000, take it out of the deferred revenue, the liability account, and put it into actually earned service revenue. And again, looking down below at the T accounts, we would do that journal entry every month. Okay, so again, going back through the same things that we just went through. Another summary of that, but again, that's nice maybe to go back to. Okay, then we have special issues that we will deal with. So they're all kind of unique. And again, we would, like it says down here, we'd have to disclose all of these unique things. And not all businesses have these special issues. Some do, some don't. So again, we'll kind of go through some of them in some of them in a little more detail than others. But so if we have a contract, there has to be commercial substance, has to be approved by both the seller and the customer, has to list the rights of the seller and the customer, the payment terms, and then it has to be probable that the customer will pay and that the seller will collect. If they have not assumed or performed any of the obligations under the contract, or if they can terminate it without any penalty, then a valid contract doesn't exist. So if we have Comp Stores ordered 1,000 of those gaming systems at a price of $250 per unit, but Comp Store can cancel at any time prior to delivery, we're not going to record that contract on December 20th because they could cancel at any time. But then it's prior to delivery. So once they made the delivery, then it becomes a legally binding contract. So then on January 1st, when they make that delivery, that is when they're going to record the revenue. So let's see if we get the journal entry of that or not. Okay, but we do not. But that's when they would record it. So not prior, but once they actually do the delivery. So then prepayments are part of the transaction price. Warranties are going to be part of the obligation for selling an acceptable product. So again, if we're selling products, I feel like especially here in the United States, we guarantee them to work like they should. And normally we give customers maybe like 30 days that they could return it if there's an issue. So that's like a quality assurance warranty where they don't have to pay separately for that. And then again, normally, again, like I said, there's that right of return in 30 days. So none of these things are going to be separate that we're going to record like, as a liability. Now, if they had extended warranties, so if the customer purchases an extended warranty, which many times you do get that offer when you're buying like an electronic device or an appliance or something like that, if you have the offer to pay extra for that extended warranty, then that truly is a different form of revenue. So that you're not only selling the product, but you're also selling this extended warranty. So then again, some other different considerations. Is there variable, meaning like does it go up and down depending on your sales? Like do you get a bonus? Like those kind of things are variables. If you have a sale with a right of return, again, beyond what is just kind of normal, that would be a special circumstance. And then we'll talk about the principal versus the agent. So we'll get into the details of those. And then there can be some circumstances where there's an element of interest embedded into the transaction in which we have to consider that time value of money. And then payments by the seller to the customer. Okay. So like I said, the variable consideration is when there's circumstances that make you get paid more. So maybe like with a construction contract, there might be incentive payments to get it done by a certain date, earlier the better. With entertainment and media, you get royalties on what you sell, but you don't maybe have a firm commitment on what those are going to be yet, so you don't know exactly what you're going to get in. Healthcare areas have the reimbursements from Medicare and Medicaid. Manufacturing, you could offer volume discounts or you could receive volume discounts when you're making purchases. And then there can be rebates in different types of industries that offer rebates on their product from time to time. So then we've got to figure out, okay, can we estimate these in advance? So we have to have an expected value, and we have to, or go with what the most likely amount is. But both of these methods, I feel like, involve like estimates and kind of making the best prediction because you don't know anything for sure. So then again, we've got to analyze that transaction price, either going with the expected value or the most likely amount that would be received. So we're, again, both of those involved in estimate, though, in making that decision. So then assume that TruTech can't conclude if it's probable that the revenue reversal would not occur in the future. So let's see, they're constrained from recognizing the revenue associated with the variable consideration. So they are only going to include that upfront fixed payment and then recognize the revenue of that $50,000 each month. So let's see, and it would be in their deferred revenue. Okay, then now though, so that's initially. So so I think we're missing a little piece in that last slide. Sorry about that. But there's a bonus involved. So if I go back there, this was their regular upfront payment. They're going to get $300,000 and they're going to recognize $50,000 each month out of that 300. But then now they're also offered a bonus. So they could end up making a $180,000 bonus, but they couldn't feel comfortable that they were definitely going to get it or expect to get it. But now 3 months in, they do think I am going to get this bonus. So once they realize that they can make an accurate estimate and it's probable, then they'll go ahead and record it. So they'll put in, they get 3 months out of the 6 months of a bonus. So they're going to get a $90,000 bonus receivable, and then they're going to record that as revenue. And then the $300,000 is what they already got prepayment. They're still allocating that out every month at the $50,000. So that is going into their revenue. But then now they're going to start to allocate in that bonus because they do feel confident that they're going to get it. If the customer has the right to return the good, if they're not satisfied, or if they're unable to resell it, then the company has to, sorry, let me go back there. They have to report the sales revenue equal to the gross sales less the estimated returns. So either, again, if they actually returned it, you'd know that. But say they've got 90 days. Let's say they've got 90 days. If they can't resell it, they can return it. Then you're going to have to estimate what do you think is going to come back based on prior experiences or past, knowledge. So then here they estimate 5% of them will be returned. So they're going to record the sales revenue as those game boxes go out, and then they're going to estimate 5% and put it into an estimated returns account. And then as the returns come in, they would take it out of there as the actual returns come in. Then the principal or the agent. So if it's a company that's supplying their own goods, they provide the goods and services, they have the inventory, they're making it, and the customer is going to pay them directly, then they're the principal. So like anyone you go to a store and you buy the product from would be. An agent is somebody who's facilitating the transaction. So like in today's world, and again, I don't sell on Amazon, so I'm not 100% sure how it works. But as I kind of read those, I think like Amazon would be an agent. So Amazon does have some of the product in their warehouse, but some of them, they just facilitate the transaction between like small business owners and customers. And to facilitate that transaction, they definitely are going to charge them a fee. So then there would be a commission or a fee charged. So then here we have, if they're selling directly, they're gonna on their income statement, they'll show revenues, cost of goods sold, and then gross profit. If they're the agent and all they're getting is a commission or a cut on the sale, they're not going to have any cost of goods sold because it wasn't their product. They didn't buy it. They don't have any costs associated with it. They're just getting a commission fee of 50. Then the time value of money, see, those are ones that have like a financing component. So maybe you're going to, I think it'll give us the example of the person gets the product on the first of the year and then they pay at the end of the year. So then in that case, part of that payment is going to be related to interest. So they give us, they enter into a contract where they deliver the modules on January 1st and they pay $863. Oh, so no, this is going the opposite direction. They pay $863 in advance and then they deliver the modules on December 31st. So then there's an element of interest in there just due to the timing. So if you used your time value of money keys and you computed the future value of $873 today using a 10% interest rate, you would get this $960. If we have, so this is the other direction. This is what I was thinking that last slide does. If we deliver the modules in advance and then the company doesn't pay us till the end and there's an agreed upon price, we know that agreed upon price includes interest. Or in this case, they're calling it a discount. So again, though, it's similar to that. So they're going to pay us the $1,056 in advance, but we recognize that part of that is interest. But again, when they pay it in advance, we call it a discount. And we could use the same time value money keys. Now this would be a future value of $1,056 at 10% for 1 year. And then you'd compute the present value and you'd get the $960. So that's what we would record as revenue. And then the 96 would be the discount or the interest. Okay, so then this is saying that if the fair value of the goods and the services, if they pay more than that, those excess payments are viewed as a refund. So subtracted from the amount the seller is entitled to receive when calculating the transaction price. I'm not 100% sure what that slide's referring to, so we'll kind of skip that. Okay, then we get into these different types of arrangements. And again, some of these are common. So like licenses and franchises are very common in today's world. The bill and hold arrangements, that's where, I don't know, you get into some questionable accounting practices that you want to make sure you're doing everything right, because that could be a way to kind of manipulate revenues. Consignment arrangements, I mean, that happens with, like I'm going to use an example of like dealerships. So if you're selling like campers or boats or cars, normally the manufacturer still owns them and they're on the dealer's floor to sell, and the dealer will obviously get their commission, but they'll pay interest to have those on their goods. They don't actually buy the cars and have them like as their own cost. So that's a little bit of a consignment arrangement. Or think of like craft stores where people are making the crafts and then somebody taking them to a store where somebody's selling them. And then gift cards are also very common in today's market. So a license allows somebody to sell a product, and then that person, the person who actually created it, so say they have the patent or the, you know, the like the trademark or whatever, the copyright, I guess is what thinking of for the download. So if they have the copyright or the trademark or the patent for a product, they can allow other people to use it, but they're going to get paid a fee. So that license allows people to say like download music, download videos, but they've got to pay a fee to the actual producer of those. So then if they have the right to, again, use that trademark, that logo, they would record that income over the time that it is covering. Franchises are when people buy into franchises to be able to operate a business, and it'll be for a specified period of time. So like, again, say you own a Subway, that's a franchise. So you can open that Subway and advertise it and use their name and all that stuff. And then you're going to pay a license to be able to use that franchise. Bill and hold is when the customer purchases the goods, but then they ask the seller to retain them until a later date. So the revenue, you shouldn't record it until the actual delivery to the customer occurs, because the customer doesn't have physical possession, the seller still does, but it's like marked for that customer and set aside. But until it actually goes out to them, you wouldn't record the sale. Consignment, again, is when you still own it, but somebody else is selling it for you. So consignment goods are never really purchased by the person who's doing the selling. So the consignor should not record the revenue until it's sold to a third party and the money is collected. Gift cards are when they're sold, they're recognized as a deferred liability. And then as they are claimed and used, then they can be showed as actual revenue. So all of these things are disclosed or recorded. So on our income statement, we're going to have the revenue, the bad debt expense, interest revenue or expense. The balance sheet will show contract liabilities and contract assets for those long-term assets, accounts receivable, notes receivable. Everything will be disclosed in the notes to the financial statements. And then the long-term contracts, again, we're recognizing revenue over a contract that extends, like let's say it takes 3 years to build a stadium or something like that. So obviously the contractors who are performing those services are going to need money in those 3 years. So here, again, this construction company is going over 3 years, and it's a $5 million job. So according to the contract, they're going to be allowed to get installments during as time goes along. So normally what we do is we try to come up with an estimate of how far along we are. So the best way to do that is to look at our estimated costs. So what costs have we incurred? What are our total estimated costs to complete it? So then what percent are we done? And then we'll calculate that to determine how far along we are, and that'll help us determine our revenues that we'll get to record. The billings are normally spelled out in the contract. Again, we can bill them over those installments. So that lists out how we get to the $5 million down below here, and then how we've collected the cash. But then here you can see again, kind of some of the recordings. So as we incur the bills, we put it into an account called in construction in progress, and we pay for it. And that ties back to the actual costs that were incurred. Then the second part is how we were able to bill them. So in total, they're paying us $5 million, but we were allowed to bill them in increments over the 3 years. And then the final one is how did we collect on those billings? And then here again shows us the upon completion, what costs did we have, what total revenues did we receive, and what did we allocate over those years. So then this again is just showing you at the end, once the contract is complete, we had an extra 900,000 that was recorded at the end of it. So this kind of shows you again how we calculate those revenues based on that percentage of completion. And then again, it shows it out, mapped out to you by year. So you can kind of see all that. And then those are the journal entries made for each year, showing what, so that construction in progress is like an asset on your books. The costs would be cost on the income statement, sorry. And then your revenue would be revenue on your income statement. Okay, so you can see though that gets kind of complex crossing over those years. So look those over just to kind of see, because again, it's a little detailed to kind of go through step by step on this video. But then once it's all done, we close it out. So then we take that asset, that construction in progress asset off of our books and then put it into billings on the construction contract. So then here at the end of the year, it shows you then for while it's in process, we'd have our accounts receivable, our billings on the in excess of the costs, and then our this is over time and this is on completion. So I guess it's the same. What's different in those? I guess the profit is changing again because we're getting to the end of the contract, I guess. Okay, so definitely look those over though, because that is a lot of detail to cover verbally. If you have any of those in your homework, go back to those slides to kind of map those out.